Okay, Biz 101 students, today we're going to be talking about how companies make use of financial information. In the old days, we'd have called this chapter accounting, but today we're going to be talking about how accounting information and financial information in general is used by businesses to be able to make better financial decisions. So what are our goals for this chapter? Our goals are to understand why this information is important, what the different kinds of accountants do. We're going to be talking in detail about the steps in the accounting cycle. We're also going to be talking about what the balance sheet does and how it gives us an idea how well an organization is doing. We're also going to be talking about how we can know if our company is making a profit or if we're in a good financial place or not. And we're also going to be talking about ratios that can be tied in as well. So ratios, of course, meaning like a 1-to-1 ratio might mean you have one teacher for every student, or you might have one teacher for every 30 students. Well, if you have $1 of debt for every so many dollars in revenue, how are you doing? That's an example of a ratio. And we're going to be talking about some of the major trends in the industry. So this class should not be counted, or this lecture should not be counted as a substitute for a specialized accounting class, but we are going to get into what accounting actually is. Accounting, in the general sense of the word, simply means you're writing things down. If you're accounting something, you're writing things down in a ledger. So our text defines it as the idea of collecting, recording, classifying, and summarizing reports and financial activities. What it really tells us is where money is going in an organization and how we're doing. Whether or not you are a for or nonprofit organization, all companies need accounting. If you've got money moving through your fiscal veins, you need accountants. Even if you're a non-for-profit organization, in fact, sometimes for nonprofits or non-for-profits, it's even more important, because if you do not keep an accounting where your money is going, you might lose your tax-exempt status. And it also provides documentation of where the money is going. So the accounting system really has three kind of primary functions. The first is to be able to take information, categorize it, and put it in the right place to prepare reports. And finally, those reports are used by people inside and outside of companies to be able to make decisions. So again, you're summarizing the data, you're putting it into a form that it's readable, and people are actually making use of the data internally or externally to your company. So what are some of the reports that are provided? Inside an organization, we call that managerial accounting. You might want to know how sales are going. You might want to know how production is going. You might want to know what people are getting paid. External means that people who are stakeholders in your company, like people who own stock, people who lend you money, or the government, for example, might want to know what your balance sheet looks like. So in other words, what money is coming in and out of your organization. Your income statement says what kind of income you have, and your statement of cash flows ultimately explains where the money is going in and out of your organization. So managerial accounting is internal, financial is external. So if you're helping people make decisions within your company, you're acting as a financial accountant. If you're helping people outside of your company to better understand the finances of your company, you're involved in financial accounting. So again, managerial, internal decisions. Financial, external, people who have interest in your company's well-being. So a managerial or a financial accountant can work for the same organization. We might say, for example, a Ford Motor Company. Our managerial accountants are helping us make decisions based on if we're going to expand our company or not, or get involved in a new product line. Our financial accountants are doing our tax reporting, or reporting for our shareholders, all the people who have an external financial interest. And again, the key parts of the annual report are the balance sheet, income statement, and statement of cash flows. And we'll be talking through all of those as we get through this lecture. So a public accountant is somebody who can work for anybody. If you are for hire, you're a certified public accountant, you can work for anybody. And CPA is a great certification, but you can be a non-CPA public accountant. Private accountants only work for one company. So if you work for Ford Motor Company, you're a private accountant. If you work for Tonkin and Company and you do all kinds of consulting to other organizations, you're a public accountant. And in terms of the legislation that affects accounting, the main is the Sarbanes-Oxley Act, which came out in 2002, and which that basically meant we needed to have some level of reporting on how our internal processes are working out, better transparency for companies. Keep in mind, this was right after the dot-com crash of the late 1990s, and a lot of people lost their money in the markets because companies weren't honestly reporting their financial data. So the primary accounting equation goes like this. It's assets minus liabilities equals equity. So assets are anything that you have that's valuable. If something is tangible, tangible stands for touch. Tangible means you can touch it. It's got actually cash value and it's physical cash in hand, equipment, buildings. All these things are tangible. And then you've got intangible stuff, things that have value that can't be touched, such as intellectual property. For example, the iPhone. We can touch an iPhone, we can put it on a table, we can use it, but the code and the concepts and the patents behind that iPhone are as valuable as the tangible assets. Liabilities, that means what do we owe somebody else? So do we have debts? Do we have a bond out on us? And after that, we have what we refer to as owner's equity. So we take what we have that's of value minus what we owe people, and that gives us our owner's equity. So that tells us how much our net worth is. So again, in terms of the accounting cycle itself, we'll be stepping through this. The first is to analyze business transaction documents. In other words, we have records of what we're selling, records of what we're buying. We're putting those into a journal, most likely an electronic journal at this point in time, a spreadsheet or some sort of a database. Then we're posting journal entries to ledgers. That means that we're breaking it down by specific departments, for example. A trial balance is basic math, meaning we're just at a high level seeing, are we in the black, are we breaking even or making a profit, or are we in the red? Then we get down to step 5, which means we're preparing financial statements, and that means external information for people outside of the organization, and finally, or inside the organization, and finally we're analyzing the reports to see where's our money going, how can we be more efficient than we currently are. So what are the 3 key documents? The balance sheet, the income statement, and the statement of cash flows. The 3 key documents in all of accounting. So what does our balance sheet show us? It shows us what we have in terms of assets. It shows us what we owe people, our liabilities, and lets us know, are we in the black or in the red? Our liquidity, same as we talk about the stock market, how quickly can we turn things into cash, such as inventory, such as fixed assets, things like buildings, how quickly can we get cash? And again, it comes back to the fundamental accounting equation that we're always talking about. Assets, for example, current assets means you can convert it to cash within 12 months, so things we can sell quickly. Cash simply is, do you actually have some extra cash lying around? Do we have money left over we've been putting away for a rainy day? Marketable securities means that we've got temporary investments that we can sell quickly. And for example, we might have bought shares of stock in another company. We can get rid of those very quickly. Accounts receivable means people bought things from us on credit and they owe us. Notes receivable means that we lent money out to other people, actually lent people cash, and companies do this even for employees sometimes, and we can collect that because it's owed us. And finally, inventory is anything we can sell very quickly. Some people keep that as part of current assets, but inventory specifically are things that we would sell as a product that we can get rid of very quickly. Fixed assets, things like buildings, machinery, stuff that might take a long time to unload, big investments. When things depreciate over time, it means they lose value. For example, when you get a new pickup truck and you drive it off the lot, it immediately loses value. And again, intangible assets are things that we can't touch but that have financial value, such as patents or other kinds of intellectual property. Then we get into liabilities, and we're talking about what we owe people here. Current liabilities mean things that we owe that need to be paid off very soon, and those can include accounts payable. For example, we bought things on credit we need to pay back. Short-term loans, which are notes payable. Expenses, for example, do we owe people for wages? Do we owe people for the lights being turned on, the air conditioning? Do we owe income taxes if we're a for-profit company? And what about current portion of long-term debt? If we have a long-term loan, we call that long-term debt. So if we owe a rent or a lease or for a loan, for example. And then we have long-term liabilities, and that means if we have got things that are taken out of several years, loans that are taken out of several years, or bonds that we've issued that are going to be maturing over a period of years, those are long-term liabilities. Owner's equity, again, means after everything is taken care of, do you have more than you owe? If you do, you've got equity. And that means, for example, if I owe $30,000 on my house and my house is worth $120,000, I've got equity. So It comes down to if your property, if your company, if your assets are worth more than you owe, you've got equity. So that takes care of the first part of things. Let's get into the income statement. We covered the balance statement. Let's get into the income statement. That means in a period of time, could be a month, could be a 6-month period, how are our revenues and expenses? So we're getting to see trends here over a period of time. Did we make profit or loss? And for example, our income statement, if we're a typical retail company, might look different at the end of December than it looks at the end of March. Why? Well, because it's the holiday shopping season. So we can see, for example, that even though we're doing terrible in March, we were doing great back in December. So we might be looking at how we can balance our spending over the entire year based on what we're bringing in any given period. So our income statement looks at a snapshot, a specific period of time. When we get into, again, revenues, expenses, net profit or loss. Revenues simply mean the money you're pulling in. It does not mean profit. Money coming into your company is revenue. If you're selling things, that's revenue. Expenses means what did it cost you to stay operating. So we have operating expenses such as paying people, such as paying for the light bill, and we have cost of goods sold. That means, for example, if I sell t-shirts, I still had to buy the cotton to make the t-shirts. I had to buy the lumber to make homes, for example. Those are costs of goods sold. And again, that determines if we have a net profit or a net loss. Net profit means after expenses, we are making money. Net loss means after expenses, we're losing money. Remember, I told you earlier in the semester, for the first 10 years, Amazon did not turn a profit. They had lots of revenue, but not lots of profit. And then we get to the statement of cash flows. And that means we're looking when the money is going in and out of a firm. If you're a managerial accountant, what you want to be able to do is determine, are there places we can be more efficient? We're looking over a period of 1 year where cash went in and out of a company. For example, we might be paying more for labor in the summertime if we're in the hospitality business because we've got more people going on vacation. If you're a publicly traded firm, you have to show people where your money is going. Why? To make sure it's not going someplace crooked, that somebody's not embezzling or poorly investing investor funds. And then we get into what we refer to as ratio analysis. And what ratio analysis is all about is the idea of determining how well a company is performing by comparing numbers. As I mentioned before, ratio might be, for example, if we have 1 instructor to 12 students, we've got a 1 to 12 ratio. Well, other ratios can tell us financial information. So a liquidity ratio tells us how quickly we can pay our short-term debts. How quickly, for every dollar in debt, how many dollars do we have in liquid assets? And then we have a current ratio, which just looks at assets to liabilities. So, in other words, this is what we own, this is what we owe. Assets own, liabilities owe. And we get to an acid test ratio. It's the same as a current ratio, except it does not include your inventory. It just looks at more fixed assets and cash assets, not necessarily inventory. Then we get into profitability ratios, and that means for the money we're spending, how much money are we making per dollar spent? So a net profit margin means the percent of each sales dollar after expenses and taxes. Return on equity means if people are investing in, for every dollar somebody invests in your company, what do they actually earn? And we can even break that down to earnings per share, ratio of net profit to shares of common stock outstanding, and that means basically if we are getting the net profit, and how does that break down the net profit of a company versus the actual number of common stock shares that are in the market. Activity ratios are important if your company has perishable goods or is a high volume business, for example. If you are a company that deals in produce, fresh fruits and vegetables, for example, you've got to have a very quick ratio. In other words, if your goods are moving quickly, you've got a high activity ratio. That's good news for you in that business. Involuntary turnover ratio means how quickly do we turn inventory into sales? And again, how important that is to your business depends on how perishable your inventory actually is. Then debt ratios. We're looking at what we refer to as debt to equity, and that means how much debt do we have versus equity. And again, some people are more comfortable with debt than others. If you've got an unfavorable debt to equity, if you owe more than your company is worth, you're not in a good spot. And folks, that is a very, very quick look at the world of accounting. I appreciate your time and attention today.